Hi everyone, welcome back to the channel. My name is Ari and you guys are watching Finance Grid. In today's video, I'm going to be going over what is SPAC, which has been taking the IPO sector to the roof. So I'm going to explain to you what is it, how does it work, the process, and some additional tips. So stay tuned. So what is SPAC? SPAC stands for Special Purpose Acquisition Company, that was created for only one purpose, for the purpose of raising money through an IPO with no business, with no product, and using that money to purchase an existing business. This is what SPAC stands for, and that's what they do. So how does SPAC work? It's actually very simple. So let's start from the beginning. So a SPAC has been formed. They raise money through an IPO. Now they're sitting on a bunch of money. So step one for them is to take this money, put it in a trust fund, in a short-term trust fund. They can actually gain interest, and then they have the time to search and try to acquire a company that they feel that will be profitable for them for the long run. So this is step one. Now they have between 18 to 24 months to try to find a company after this SPAC company has formed. If they're not able to do so, then this SPAC company will be dissolved and their money will be returned back to the shareholders. Once they're able to find a company that actually want to acquire and it has been approved by the shareholders and the regulator, they will start a new process called the de-spacing, where they're going to start merging the newly acquired company with the SPAC company, and then they're going to change the name of their ticker of the stock exchange. So it's going to have the same name of the acquired company. So this is in a nutshell. So we're going to try to compare IPO and SPAC. What are the difference? So if you look at the timing for a SPAC merger or SPAC acquisition, it can take between 3 to 4 months. If you look at the traditional IPO, it can take between 6 months to 9 months. Now in regards to the process when it comes to SPAC, it's much more shorter, much more easier. You have less people that need to review it. So it's literally the SPAC management team and also the regulator need to approve. And when it comes to traditional IPO, you have to make a comprehensive preparation, involve the whole organization, really go through a long channel until you get the approval. Now, if you look at the pricing of the company, if it's via SPAC or traditional IPO, SPAC seem to be more in favor of the company that is being acquired. They're able to close on a price, which will give them a certain certainty that they're gonna have the money and the stock will be traded at a specific price or from a specific price. As whenever you do an IPO, there's no guarantee what will be the price once you go public. You need to do a roadshow and then literally try to raise money, which is it's a bit risky and it doesn't give you reassurance that you're gonna be able to raise the money that you want to raise. Now it also seems to be cheaper to do a SPAC merger or acquisition or to go through a traditional IPO. So from what I'm able to find out, it's a difference between 6% and 5.5%. And there's obviously the whole package when you actually do an IPO through SPAC, that the companies that acquire you actually has a lot of expert people that can really help you take your company to the next level. And if you do it through a traditional IPO, you don't have the same support, the same connection. You are a little bit more limited, and you might have also some lack of money, some more and more issues that might come if you're to do via a normal IPO. Now, from a shareholder perspective, whenever you actually are doing a SPAC IPO, a SPAC merger, one of the advantages that the SPAC management or the SPAC sponsor get is they're actually able to get at a very big discount the company shares compared to the holders or compared to the investor. So let's give an example. If I have a share of the company going to be acquired, let's say the current price is $10, and the SPAC management, the SPAC sponsor if they perform well, and also they can buy 20% of the outstanding share at a big discount. So if I pay $10, they can actually pay $1. So this is something that has a way to it can really impact whoever's owning the shares of the company before it has been acquired via SPAC. It can actually devalue your share price because someone else is acquiring the same amount of share but actually putting less money than you. So this is something that is probably not in a favor of employees that work in companies, because you have now a new big player that will come in with a lot of money, and for maybe 10, maybe a much smaller percentage, is able to buy 10 times or 15 times more for the price that you put. So this is something that you should obviously consider. But again, you should also do a little bit more research to understand a little bit better. This is just from my perspective how I look at SPAC and IPO. Until next time, bye bye.